What's going on, everyone? Welcome to Valley Green and welcome to another video. Are you looking for some quick, easy ways to make some option premium income using options? Well, if that's the case, I'll show you how to do that weekly. I'll show you how to do that monthly. I'm going to quickly walk through some examples on some option strategies that you can utilize. And a quick reminder, if you could like, subscribe, and comment down below any stocks you want me to cover, that'd be awesome, as it would really help out and support the channel. There's also a couple links down below for some resources that I use on a daily basis. Now, quickly jumping in, Tesla. Tesla is one of the stocks that I cover over and over and over again. It's an amazing stock to trade options on, to sell options on, an amazing way to create extra income. If you don't know, Tesla creates electric vehicles. So how can you trade options with Tesla? So I'll quickly walk through that, and I'll be using Robinhood today for the example. So as you can see, Tesla's kind of come down over the past year, dipped all the way down to 110, 115, back up to 185. But if you look at the 1 month chart, it's kind of stabilized, and this could be a really good entry price point. So I'm going to run a couple scenarios for you. Let's say you have a substantial amount of capital and you are willing to purchase Tesla today. If that's the case, then selling puts, assuming you have $18,000 of collateral and are willing to purchase Tesla at almost today's market price, then cash secured puts are the option strategy for you. Now, don't worry, if you have way less than $18,000 in capital and are still looking to try to sell options, trade options to create income, stay tuned. I'll cover that right after this example. So what are you going to do? So for a cash secured put, you're going to go to put and you're going to go to sell. And the first thing you need to do is you need to determine the expiration date that works for you. So typically, I like to go about 30 to 45 days out. Then you can maximize theta decay. After selecting the expiration date, you would look at the strike price that you want to sell a cash secured put at. So currently looking at Tesla, the share price is $186. Now, if you want to be conservative and you say, hey, I'm willing to purchase Tesla at 160, amazing. You can sell a put at 160 and collect $480 today. Now, what's going to happen? So let's say by May 19th, Tesla's trading at 170. Okay, great. Nothing happens. This option expires worthless, and the 480 is already in your account. That's in your account today. Now, what happens if Tesla's below 160? So effectively, you'll be put the stock at 160. But you can see here your break-even price is about 155 because it's the 160 minus the credit that you've received today. So it's about 155. So again, Tesla's trading at 186. If you're willing to purchase Tesla today at 186, then you should really consider a cash secure put strategy, because it's an easy, simple way to gather additional income while just sitting on the sidelines and waiting for Tesla to go lower and purchasing it even cheaper. If you want to be super aggressive and you say, hey, I want to purchase Tesla today at 185, 186, well, why not sell a cash secured put, get some additional income before just purchasing 100 shares right off the bat? If you were to do this, you can collect almost $1,300 today if you were to sell a cash secured put at 185. And again, this is only if you actually want to buy Tesla and purchase 100 shares, because remember, one contract has 100 shares in it. So you have to look at the strike price today times 100 shares, and that'll be enough for a cash secured put for one contract. Now, you may be wondering, well, wait, I don't have $20,000, $18,000. I can't do this. That's true. But there's another strategy that you can do that is much better, much more feasible for smaller accounts. So now let's take a look at the 165. Let's sell a put. So we're selling cash secured put here for 165. So in theory, we collect $6 today, or $600 given one contract, 100 shares. Let's say you only have a couple $1,000 and you can't purchase 100 shares of Tesla at 165. That's totally fine. We're going to then add a put. We're going to buy a put. So typically you're going to look one leg down. So I'm going to buy a put at 160. So what's happening here? So right here, I'm selling the 165 put and I'm buying the 160 put. So I'm buying the put at a leg lower for the same expiration date. So effectively the risk I'm putting up is 5 points. So the 5-point spread between these two strike prices. So I'm risking $500. Today, I'm collecting $110. So if I execute this trade, $110 will be deposited into my account. So yes, there is a risk where Tesla drops below 160 and then you do have this max loss of $380. That is a scenario. But this is a great option strategy if you have a much smaller account, you're bullish on Tesla, and you think this entry point, this strike price, Tesla won't go to within the next month. This is just an example. You have to pick your own strike prices and do your own research, but I just want to walk you through that. Now, let's take a look at the second example we're going to go through today. So Snowflake. As you can see here on the 1 year chart, Snowflake had a peak around, 198, 200, came all the way down to 120, somewhat stabilized over the past couple of months. If we look at the 1 month chart, definitely a spike up, and now it's kind of moved downwards. So what is Snowflake? So they provide cloud data warehouse software. They have a market cap of $45 billion, 52-week high of 222 and 52-week low of 110. In my opinion, this is still a growth stock. I would be bullish on this stock. So I'm going to quickly show the same example that I just did on Tesla, but for Snowflake. I'm going to quickly show a cash secured put and then a put credit spread. So the first thing we have to do, change this to put and sell, and then update the expiration date. So May 19th, 38 days out. So cash secured put. What would I be willing to purchase Snow at? So let's look at 120. That's a pretty decent drop from where it's trading today. So, I'd be willing to purchase $12,000 worth of Snowflake at 120. That's almost 20 points lower than where it's currently trading. And to do that, I could collect $300 today. I could sell a 120 cash secured put for 1 month out and collect $300 for just waiting until May 19th. So that's a little bit over 1% return, given, $120, $300. This would be $300 over $12,000. That's kind of the, percentage return that you'd be getting in the 1 month time frame. But remember, if the stock does go below 120, you are obligated to purchase 100 shares at 120. You could always buy back the option, which it'll be much higher, but in theory, you'd be put the stock for 120 if you just let it expire. Now, the next strategy is going to be the put credit spread. So now this is going to be optimal if you have a much smaller size portfolio. So we're still going to sell a put. So let's go back. Let's just go back to 120 actually. Let's buy a put. Now let's buy one leg lower. So now you can see it changed to put credit spread up in the top right. Now the spread here is 120 minus 115. So that's a 5-point spread. So in theory, I'm putting up $500 of collateral. And to do that, I'd be collecting $71 today. So that right there is almost a 15% return in 1 month's time frame. But now remember, Snowflake can't go below 120, below 115. Otherwise, you could have this max loss of $414. So yes, this may have a higher risk to reward ratio. You just have to determine what strategy works best for you, what size your portfolio is, and how aggressive you want to be. Now, the last stock we're going to talk about is Apple. I'm sure everyone's heard of Apple, iPhones, iPads. Most people have smartphones these days, so Apple is one of my favorite. Let's talk about it. Looking at the chart here, you can see it's had a quick run up. It's kind of peaked here on April 4th. You can kind of see it peaked here on August 15th. Looking at the last month, it's had a run up here and it's peaked. So in my opinion, it's kind of in a downward trend right now, and it may continue downward. It could be, overbought at this point and moving downward. So let's look at some more bearish option strategies. I'm not going to do a covered call. I'll cover that in a different video. I'm going to do the opposite of a put credit spread. I'm going to show you an example of a call credit spread. So this is going to be a bearish strategy. So currently, I'm assuming Apple's not going to continue to move upward in the short term. May come down a little bit. So I'm going to change the expiration. I'm going to go to call, and now I'm going to be selling a call. So it's going to be a similar setup as before. I'm going to sell a call at, let's say, 175. Apple hasn't really peaked there. I don't think it'll go that high in the next month. So I'm going to sell a call. Right now, this would be a naked call because I don't have any of the shares in this account, and I'm selling a call without owning 0 shares. So what am I going to do to sell a call credit spread? So now I need to go one leg higher and buy the call. So I'm going to buy this call, and what it's showing here is that I would collect $56 today if I execute this trade. So I'd be putting up $500 of collateral in theory. I'd be collecting $55 today, $56 today. So that's roughly a 10% return. And you have to think this is about 38 days out, so almost a month. So about a 10% return in a month. If you did this every single month for the year, that'd be over 120% return in a year. So I know it's a little bit shorter of a video. If you liked it, would really appreciate it if you could like, subscribe, and like I said before, comment down below. Let me know any strategies, options, stocks you want me to cover. I'd be happy to do that in a future video. Hope you have an awesome day.